Hello, today is May the 12th, 2022, and it's time for some new stock picks. As always, I'll review the picks from this time last year, and then talk about the new ideas and the current conditions and the rationale behind those new ideas. So this time last year, I picked Big Lots, symbol BIG. That was down 50% since this time last year. Triumph Bancorp, symbol TBK. That was down 16.1%. And LGI Homes, symbol LGIH, which was down 45.9%, for an average of down 37.3%. That compares with the World MSCI Equity Index, MSCI World Index ETF, the URTH ETF, which was down 6.4%. The performance of these picks is obviously really not very good, but that gives us an opportunity to comment on that. It is important to be very well diversified, not just by the number of stocks, but by asset class, as we always do for our portfolios. That's lesson number one. And it's also worthwhile noting that while we report the 1 year performance, stocks are longer term investments. And if the businesses are still good and the prices are even better, like in this case, we would continue to own them as we do for these three. Now going forward, this year, especially year to date in 2022, has been rather unusual in that we seem to be entering a stagflation where there is a higher inflation than usual, and possibly stagnation in economic growth, meaning lower growth than usual, or even negative growth, which is a recession. Now, we don't know if we're going to actually get into a recession. Nobody does, but there is a good possibility that we're going to continue to be in a lower than usual growth environment, and with inflation that's higher than usual. So in response to those conditions, the central banks around the world have been raising rates, and because of inflation, bond yields have been going up, which has meant that high multiple, high growth stocks have come down a lot in price, and also bonds have come down. So this is unusual again. Usually when stocks come down, stock prices come down, bond prices go up, and that's why we have diversified portfolios by asset class, equities and fixed income. But this is an unusual year in that both asset classes are down now year to date. So it's a painful time for investors. With that being the base scenario, like a high probability for stagflation, a good place to have investment capital in is consumer staples and things like grocery stores. And with that in mind, our top pick is the Northwest Company, which is a Canadian chain of grocery stores and some housewares and some other basic things like that. The symbol is NWC on the TSX, and the valuation is very, very good, and the business should be pretty stable going forward regardless of conditions. So that's a top pick. The next pick, actually have more than 3 today because there's so many, because prices have come down for so many stocks so far this year. There's lots and lots and lots of good investment opportunities right now. So even though it's painful for investors whose portfolios are down a lot this year, this is a good time to be looking to add to stocks perhaps, or rebalance from things that are up, and add to areas that are down. One area that is down quite a bit is technology, and while we were avoiding it or underweighting it for the last 6+ months, perhaps this is a time to start adding to it, not necessarily going to the same level as what would be in a typical index, but definitely adding to it, and rather than chase the high growth, high multiple stocks, still like to look at good businesses at good prices, and one such good business is Jabil Inc. They are providing manufacturing services to companies like Apple and Cisco, and the stock is very, very reasonably priced, and it's down so far this year. So that would be a good way to, and a safer way to add to technology than through the high multiple high growth stocks that are down even more and have a possibility of doing better going forward. But we like the safer way. And another area to look at is Timberland. If someone doesn't have any exposure to their portfolio, it's a good place to have a little bit of money, not a lot. And one company called Potlatch Deltic Corp is mostly in Timberland. They do own and operate the Timberland resources that they have in Alabama, Arkansas, Idaho, Minnesota, Mississippi, and places like that. But they also manufacture wood products, such as lumber. So lumber prices are high, and so they're doing quite well right now. So they may come down, and so there's a little bit of a risk in that. But the valuation is reasonable. The company is strong, and the timberland assets are long term. So especially for someone that doesn't have any, that's a good place to have a little bit of money. I'm going to give a bonus pick this time because, like I said, there is lots and lots of good areas to put money to work right now. This is going to be in the oil and gas area, and not everybody is comfortable investing in oil and gas, but for those who are, the thesis for investing in oil and gas right now, despite the fact that they're actually the stocks are up this year after being up last year as well. So we're buying after prices have moved up, is the following. There's been a massive underinvestment in the conventional oil and gas exploration and production for the last 15 plus years, primarily due to what's called ESG concerns, environmental, social, governance issues. That's been a big trend for a long time. For example, myself, I did not invest in oil and gas for easily the last 15 years, but before this recently, yeah. And the result is that these companies won't be able to produce as much oil and gas as the world requires to grow, because the capital that was invested in a new project was less than what's required for growth. So the new money that's being invested right now will take 4 to 6 years before production comes online. And energy from other sources is harder to bring online, such as whether we're talking about electricity through nuclear, coal, hydroelectric, wind, solar. And the world economy, in order to grow, requires growth in energy. You need more energy to make more stuff. And the world population is still growing, while the energy production seems to not be able to keep up with what's required. So there is a shortage, possibly, of energy, and the stocks for these companies, oil and gas companies, are still priced quite cheaply, perhaps 1/3 of where they should be based on historical norms. So they still represent a good investment opportunity. Of course, if we go into recession and the price of oil, especially oil, goes down, they will go down, even if they're fairly priced or even cheap. So it's a risky play, but it's still worth having a little bit of money there. So the company that I picked is called Baytex Energy Corp, symbol BTE on the TSX, and it's trading at ridiculously low PE multiples, but everybody knows you can't trade these stocks based on PE multiples, price to earnings, because they're so cyclical. But it's more about the intermediate and short to intermediate term, let's say 4 to 6 years, where there may be a shortage of conventional energy supply. Having said all that, if you'd like a second opinion about whether these stocks or fit in, hopefully, your already well-diversified portfolio, please give us a call. Thank you.